What's up, guys? The IRS just released the new income tax brackets and standard deductions for 2021. Why? Well, each year the IRS adjusts more than 60 provisions to account for inflation and tax ranges. And tax ranges just so happens to be one of them. Meaning right now is a good time to start tax planning for 2021, even though we're still in 2020. So we'll be going over what has changed, what hasn't changed, and how the upcoming election plays a part in what the IRS just announced. So make sure you watch until the end of the video. I'm Karan from Life Accounting, where we save small businesses from high taxes and low profit. Let's dive in. If we compare 2020 and 2021 tax brackets and rates, we notice a couple of things. First, that the actual rates have not changed. In fact, these rates haven't changed since 2018. We see that they are still 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Okay, what about tax bracket income ranges? The lowest rate of 10% applies to those filing single and make $9,950 or less, or those filing married and make under $19,900. This is a jump of $75 for those filing single and $150 for those filing married when comparing it to the 2020 tax bracket. Even more than that, every dollar up to $40,525 if you're single and $81,050 if you're filing married is slapped with a tax of 12%. This is a jump of $400 at the end of the bracket for those filing single and $800 for those filing married jointly when compared to the 2020 tax bracket. For every dollar after that, the rate is 22% for those filing single who make up to $86,375 and those who are married who make up to $172,750. This is a jump of $850 at the end of the bracket for those filing single and $1,700 for those married filing jointly when compared to the 2020 tax bracket. If you happen to spill into the next tax bracket, those dollars will be taxed at 24% for those filing single who make up to $164,925 and those married whose income exceed $329,850. This is just a jump of $16,025 at the end of the bracket for those filing single and $3,250 for those married filing jointly when compared to the 2020 tax bracket. Every dollar after that, Uncle Sam tags in the undertaker and taxes you at 32% for single filers who have income up to $209,425 or up to $418,850 if married filing jointly. This is a jump of $2,075 at the end of the bracket for those filing single and $4,150 for those married filing jointly when compared to the 2020 tax bracket. A 35% rate applies to taxpayers who earn up to $523,600 and are single, or who are couples who earn up to $628,000. This is a jump of $5,200 at the end of the bracket for those filing single and $10,400 for those married filing jointly when compared to the 2020 tax bracket. And lastly, at the highest of highs, any dollar that does not fall into the previous tax bracket plunges into the 37% tax rate when compared to the 2020 tax bracket. All right, I know that was a lot, so what does it all mean? Well, in short, it means that compared to 2020, next year's tax rates jumped about 1%. Now, something we need to remember is that the tax brackets are marginal, which means that each range of income is taxed at its specific bracket. Here is a good example of how that looks. Notice how each specific range of income is taxed in accordance with the bracket of income it is in. So, for example, if you make $50,000 per year, placing you in a 22% tax bracket, not all $50,000 will be taxed at 22%. You can take a breather. All right, let's talk about the standard deduction. When you file your federal income taxes, you choose to claim either the standard deduction or itemized deductions. Why is that? Deductions reduce your taxable income. Here's a fun fact for you. Nearly 90% of people choose the standard deduction, mostly because it's easier to claim and it's enough for most people. Well, the IRS also adjusted the standard deduction for 2021. It's now $150 higher for single taxpayers, married couples filing separate returns, and head of household filers. You can see the 2021 standard deductions right here. Okay, there you have it, folks. Oh wait, I almost forgot. So, how does the presidential election affect these new IRS tax brackets? For example, Joe Biden plans to raise the highest personal income rate back up to 39.6%. Quick note, it was lowered to 37% by the 2017 tax reform law. Well, the election in November does not change them at all, as Congress would have to vote to change the tax rates for them to change. Basically, they're in effect until they aren't, and there's no guarantee that they will or won't change in the future. Alright, thanks for watching. If you like this video, go ahead and hit the like button for me. It will help more people see this video, and subscribe so you don't miss a video that can help you save on your taxes. I'm Quran from Life Accounting. Until next time.